Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Buying Out Retiring Partners. Before we begin, we need to cover just a few important items. First, please close any other programs you have running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit, you must complete 2 requirements. First, you must participate in 3 out of the 4 polling questions that you'll see throughout today's presentation. And please note that GoToWebinar does monitor your participation in these polls. Next, you must also complete an online evaluation. This will appear on your screen immediately after the end of the webinar, so please do not close your browser before you've had a chance to complete that survey. Once both of the requirements are met, the certificate will be emailed to you within 10 business days. Terry, if you could advance to the 3rd slide.
Sorry.
That's okay. In order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize the control panel if you wish. By using the question box toward the bottom. Just type your question and send. Time permitting, we will answer all of the questions during the session, and if not, we will certainly answer those in an email afterwards. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. We've actually are doing 2 this month. The next one is in 2 weeks on June 23rd, Preparing Your Firm to Grow Through M&A. We also have 2 webinars in July, The Art of Your Deal and one on partnership agreements. You can see a complete list of all of our webinars, including links to register to them, on the CPE courses section of transitionadvisors.com. Now, as a reminder, you did receive a link in the email that went out to you today to download a copy of today's presentation. I'll send that link now in the chat function, and I'd also be happy to email it to you as an attachment if you'd like to send me an email. My email address is on the screen now, and you can also reach me just by replying to those reminders that you received. Now I'd like to introduce our presenter for today. Terry Putney is the CEO of Transition Advisors. Thank you so much for attending, and I hope you all enjoy the webinar.
Thanks, Nikki. A couple things. First, some of the slides that are in the linked presentation are a little bit different than what I'm going to use today. I've deleted just about a half a dozen slides, so actually it's more information in the linked presentation. And then there's just some slight wording changes that really don't change the content. I'd like to encourage you to ask questions through the chat room. I'd much rather be actually sitting across from each of you and talking about your own specific situation rather than going through this presentation, but obviously that's not possible. So if you have anything that you want to make sure that we cover or that you have more questions about, I'd be happy to answer the questions. And if it fits into as we're doing it through the presentation, I'll do that, or we'll deal with those at the end. And if we get more than we can handle, we will respond to every unanswered question by email. Transition Advisors is a national consulting firm. We work only on CPA firms and only with ownership transition issues. That falls into 3 primary categories. One is succession planning, which leads oftentimes to either a merger or acquisition, or also an owner agreement. We're going to focus on the owner agreement part of that today. But we do conduct searches for M&A both on behalf of buyers and sellers, help negotiate those deals, structure them, and so forth. We also work on restructuring and developing owner agreements for CPA firms. You came to this presentation today with something on your mind that you were looking for, possibly maybe you're concerned that your firm can't afford partner retirements, it might be too expensive. Maybe on the other end, you're thinking, will there be anybody there to buy me out when it's my turn? And got 2 or 3 partners going out before you, and you're thinking, gee, this is going to build up an obligation. I'm not sure this firm can afford what's going to happen to me. Maybe you're concerned that you won't get paid what your equity interest is worth when you retire. Or possibly, maybe you don't even have an agreement and are concerned about putting one together because you have partners leaving. one of the questions I get oftentimes is, we've got young people, they're all pretty good, but I just don't trust them to take over for me in this firm. They're not ready, or maybe I just have a general uneasiness about turning over responsibilities to anybody. And then possibly maybe one of your partners recently walked in the door and said, I'm out, it's time to buy me out, and your firm just isn't ready for that, wasn't prepared for it. So today we're going to, we're seeing an unprecedented amount of uncertainty within firms about their ability to manage retirement of their senior retiring partners. Last year I worked on over 24 owner agreements for restructuring or building. We worked on many more than that M&A transactions that were driven primarily by succession problems within the firm on the seller side. The situation where the firm couldn't handle it on their own and needed to find an external solution. So on today's agenda, we're going to go over these issues. Can you replace your retiring partners? How do you do that? How do you properly transition the duties of a retiring partner? What methods are being used in the profession to structure buyouts now? How do you determine what the right value for your in a buyout of a retiring partner? What's the right financial arrangement? And what are some of the other things that you ought to have in your owner agreement to make sure that the agreement works? I'll be referring throughout this presentation to several surveys that contain important information about what's going on in the profession with respect to owner agreements and valuations, internal valuations. And those three surveys are the 2012 PCPS Succession Survey. If you're a member of the PCPS, hopefully you've obtained a copy of that. And the survey is being conducted it's done every 4 years, and so 2016 should generate a new survey probably towards the end of this year. The Rosenberg survey, of course, is conducted on an annual basis, and the most recent one that I'm referring to will be the 2015. And the other survey that I highly recommend, I recommend all three of these, is the Inside Public Accounting National Benchmarking Report, and again, that's an annual survey as well. With that, I'm going to turn it over to Nikki for our first polling question.
Okay, the first poll: firm have adequate talent on the bench to replace retiring partners? You can see the 4 answer options there. We'll give everyone about 30 seconds to complete this. And as I mentioned earlier, there will be 4 and for the CPE credit. Okay, that's nearly everyone. I'll go ahead and share the results. 47% say no, they don't. 33% I think so, but we don't have a good way to admit them. And then the remaining 20% indicate yes, I'm confident that we.
Okay, that's good. That helps me understand how to maybe put what to emphasize here throughout the rest of the presentation. The business plan for replacing retiring partners should start with the concept of what you need to do to keep the clients that are loyal to a partner that's leaving. Most of the firms that we work with have clients that are primarily client or partner loyal. Doesn't mean they have no loyalty to the firm, but they have a strong loyalty to a partner. And whether or not it's true, I think most of the partners in the firm would be concerned that when that partner leaves, that there hasn't been a proper transition of those client loyalty, that some clients will be at risk. I think the number one concern most firms have about partner retirements and transition is that we may not keep all the business that the partner is responsible for. How do we manage the value of the firm, and how do we manage that risk? What we've determined over the years is that a rule of thumb is that it takes about 2 years to properly transition our retiring partners' duties, and primarily that's with respect to their client responsibilities, although that may not be the only issue that we have to address. However, in order to have that 2-year period of time to do that transition, you need to have the replacement partners in place prior to that. Now, it doesn't mean necessarily that you're always going to transition a specific partner's client list to a new partner. Oftentimes, it's better to look at each individual client and make an assignment to existing partners and to new partners, and then possibly even assign clients that are with partners that are staying to some of the new partners. But in order to have if in fact you're needing to replace the body of a partner that's leaving, you need to give yourself enough time to not only go through the 2-year transition period, but make sure that the new partner is in place and has developed far enough along that they can take on these new responsibilities. It's easy to imagine that as a retiring partner walks out the door, his or her replacement walks in, but it usually doesn't work that way. So the timing of managing this transition becomes a critical issue. One of the techniques that we use is this kind of analysis. Let me explain what this is. In this particular firm, this example firm, we have 5 partners, and there are 2 different ways that a partner as they leave will be replaced. One is called what we call role reallocation, and the other is called role succession. In a role reallocation, what we're doing is we're taking that partner's duties, and let's assume that it's primarily client responsibilities, and we're assigning that to the existing partners. We don't have a need to add a new partner. We've got enough capacity at the partner level to do that, and there are certain situations where that may very well be the case. A role succession is a situation where we don't have within the group either the capacity or possibly the expertise necessary to replace a partner that's leaving, and therefore we've got to add a new partner in order to make a proper transition. Let me give you an example I'm working on right now. I'm working with a firm that's a 10-partner firm on a new owner agreement. They have an existing one, but it doesn't work. And within that firm, everybody agrees that there is excess capacity at the partner level. That particular firm runs efficiently with about 7 partners. However, one of those partners has a very specific type of expertise that none of the other partners have, and happens to manage a fairly large book of business. Unless we find a replacement for that special expertise, there's a good chance that the firm's going to suffer a significant loss of revenue. So in that situation, we've got, in the next 5 years, an estimated one of those we know we have to replace because there's a role succession issue. We think we can get by with not replacing 2 of the others and possibly even 3 of the others. So it's we have a combination of role reallocation and role succession in that case. Another example I'll give you is a firm that I worked with last year. In the partner retreat, was a 4-partner firm. In the partner retreat, we determined that we had a significantly strong bench with respect to retirement of all the partners except for one, who was the managing partner. Nobody in the firm could be identified as a potential successor for the managing partner. No one believed that anyone could take over that role. Even though the managing partner had another 9 years to go before, in this case, she was going to be replaced, we determined that we needed to pursue an upstream merger because we didn't believe we had the capability of finding a new managing partner within a reasonable amount of time. So that's, again, a role succession issue that it wasn't a problem of having enough bodies in place. It was a problem of having not the right bodies in place. So when you go through this analysis, what you're trying to do, of course, is determine when you need to bring in new partners, when they need to be admitted based on when you think people are going to be leaving and what kind of replacement we need to go through. So in order to make a transition successful and not diminish the value, you need to accomplish these 3 with capacity. You need to understand how to replace a retiring partner's duties. And most importantly, once you've gotten through those 2, you need to have a business plan in place that gives you enough time and active involvement by the retiring partner in the transition. Your objective should be to make the day a retired partner walks out the door a non-event for all the key constituents, which of course includes all the clients, but all the other people that are depending on that partner for the things that partner does. In order to make sure this works, the best way to do it is to tie this transition plan, the key components of the transition plan, into your owner agreement. So for instance, I've seen lots of owner agreements that had no notice period required for a partner to walk in and say, I'm out, buy me out. I mean, walk in and say, I'm out, walk out the door the next day, and there's no penalty for that. Or I've seen a lot of agreements that are with very short notice periods, maybe only 90 days. From the point of view, it's really all about, protecting the seller in terms of the way that agreement's written. But the reality is that what we're trying to do is protect the firm. And in order to do that, we need to have an adequate notice period. So we almost always recommend that the owner agreement require a 2-year notice period. And in the event that that isn't given, then the penalties can be anywhere from a set amount of discount that's applied to the buyout to potentially making the deal contingent on retention of clients or retention of business, either on a specific book of business or on the firm's overall volume for a period of time following the retirement. So, for instance, it's not unusual for us to tie that into a 2-year look-back period. What we're doing now, because I got my 2 years, but I don't think that some of my partners are going to actually do anything to transition the business during that time frame. So we started adding in some cases, an additional requirement that a firm or that a partner build, along with the firm, a written transition plan, very formal transition plan, and that if the plan is not executed by a retiring partner or transitioning partner adequately based on the firm's discretion, then that partner is treated as having not given the 2-year notice that's required. So even though they gave the 2-year notice, they in fact didn't do the transition, so we revert back to whatever the penalty would have been had they not given the 2-year notice. And we're finding that that gives firms that they can actually execute this transition. We have written and make available a generic transition plan. It's one that's been built off of many different firms that we've worked with. And that brings us to our next polling question. If you'd like to have a copy, I'll turn this over to you.
Sure. As Terry mentioned, we have that generic transition plan. It's just a PDF we can email to you. So this poll just asks if you would like to receive a copy of it or not. Give everyone just a couple more seconds to indicate yes or no. Okay, I'll turn it back over to you, Terry.
Okay. All right, the common methods that are used, alternative forms of buyouts that are used in the profession, are nicely evaluated by the Rosenberg survey. This is the 2015 survey. And I broke this into, actually, the Rosenberg survey breaks the size firms into more categories than this, but in order to make it easier to use in this case, I've developed 2 different segments of size. So for firms that are less than 8 partners, about a third are using a multiple of compensation method, and I'm going to explain what that is in a minute. And you can see the different categories. So about 13% using a buyout tied to a specific book of business, about a fourth based on an overall allocation of equity. The AAV method, which I'm going to go into in just a minute, in detail, is used by about 1 in 6. Some firms use a fixed obligation. I mean, it's just a number that all partners have available to them, or maybe there's a number based on a certain category of partner. Very few firms of this size use an equal type allocation to say everybody gets the same when they leave. And about 20% actually don't have any valuation at all of intangible value. One of the firms I'm working with right now, that's basically what they do. And we're fixing that. As the firms become larger, you start to see much more use of the multiple of compensation method. The multiple of compensation method, basically as an example of that would be, we take a partner's highest 3 years earnings in the last 5, that an annual average, and multiply that times a multiple, which generally runs between 2 and 3 times. And that might be paid over, say, 10 years. So if a partner, let's say, is making $300,000 a year on average, and the multiple is 3 times, we'd pay $900,000 at the rate of $90,000 a year for 10 years. The book of business method, oh, and by the way, going back to that highest three out of the last five, one of the nice, and I believe, I don't know if this is intentional or not in all cases, but those 2 years that fall out actually can be the 2 years that a partner is going through transition in the event that that transition results in them working less and potentially making less money. So they're not being penalized in their buyout for those last 2 years of earnings. I've seen firms use the highest 3 out of the last 7 so that they not only have that 2 years covered, but maybe they have 2 down years as well. So we can manipulate that determination of annual compensation so as to accomplish some other goals as well. In the book, tying the buyout to a specific book of business managed by a partner. The equity method would be valuing the firm as a whole. Let's say that we have a $5 million firm. We're going to value it at 1 times revenues. Internally, that would be put a $5 million value on the intangible value of the firm, and we allocate that based on some determination of equity. Oftentimes, it might be how much stock is owned, or it might be in time in the past and has or hasn't changed since. So if I own 25% of a $5 million firm, in that case I'd get $1,250,000 paid over some period of time. And then the AAV method we're going to get into right now. I'm going to explain that a little further. We wrote an article for the Journal of Accountancy. In fact, we've written over 25 articles for the Journal of Accountancy, which you can download from our website. This particular article was published last December, and we've received a lot of interest in this concept since the article was published. It seemed to hit a nerve within the profession. The article is called How to Admit New Partners, A Fresh Approach. It's really an evaluation and description of the AAV method of allocating intangible value within an accounting, determining and allocating intangible value within an accounting firm. If you're interested, I'd suggest you download it from our website. The AAV method, or it's also called the unit method. Let's go back to this example of the $5 million firm. Typically, we would tie the number of units that we've created to the volume of the firm, so it's a dynamic number. Let's say we start with 5 million. There's 5 million units, and as the firm grows or shrinks, hopefully not, but if it does, then the units are adjusted accordingly. So the next year we grow to 5,500,000, we now have 5.5 million units. What we value those units at, of course, is for us to determine. So if we decide that we want to have a 1 times valuation, then we'd value each unit at $1. We might value each unit at 75 cents, and that actually can change from time to time if it becomes necessary to adjust the valuation based on the owner's determination. We allocate those units then to each of the owners on some basis. Let's say we're starting off with a plan that might have a certain allocation of intangible value in an existing agreement. We might start at that place, but then as we go forward, the new allocation of units will probably be, the allocation of new units will probably be on a different basis. Maybe we do it equally. Maybe we allocate more units to the newer, younger partners. Maybe we allocate units based on relative compensation. There's a number of different ways we can do it, or based on an individual evaluation of performance. And then as partners leave or terminate, as partners leave either because of retirements or because of terminations, any units that are purchased or left behind are then reallocated back into the existing owner group on the basis similar to what would be done with new units that are created through growth. So let's say a partner leaves, has 1 million units, and is paid over 10 years. As we acquire those units at the rate of 100,000 units a year, that 100,000 units would then be part of the annual allocation back into the existing partner group. The benefits of this type of plan are, first, it doesn't require new partners to buy intangible value. So we can start off with a much lower investment by the new partners. They're probably not going to be allocated any existing intangible value units, and they will basically earn those units through sweat equity by helping the firm grow, participating in that growth, the units that are created from that, and also participating in the buyouts of retiring partners. So over time, they're going to accumulate a lot of units, but it's going to be through actually executing the long-term business plan for the transition of ownership in the firm. We have a lot of flexibility with how these units are allocated. They can from year to year. As I mentioned, it rewards sweat equity. It has a built-in vesting concept to it, because typically people, newer partners, aren't going to have very many units. So obviously the vesting, even though we normally do put vesting on top of it, there's a kind of a built-in holdback until they've actually been with the firm long enough to accumulate units. And it has the flexibility and the dynamic nature of a comp-based system combined with the ownership and entrepreneurial feeling of an equity-based system. So again, I have found it to be an excellent way to approach, especially firms that are having difficulty with admitting new partners. With that, we'll go to our third polling question.
Okay, the third polling question is on the screen. This one is about, I believe our approach to valuing our owner's interest in the firm is, and your options are fair and affordable, fair but I'm not sure we can afford it, not fair too low, not fair too high, or you can choose the last option if you don't have an agreement. As Terry mentioned, this is the third polling question. We'll have one more after this, and you need to have answered 3 out of the 4 in order to get the CPE.
And hopefully you don't answer it and leave. Ah.
Okay, looks like we've got nearly everyone. I'll go ahead and close the poll. The results are there on the screen. 37% of the folks chose that last one. They don't have an agreement. Of those that do, or the other options you see, 27% say fair and affordable, 30% say fair, but not sure we can afford them. And then just 3% indicating the not fair options.
Okay. All right. Thank you. Move on. Okay, so the principles of value in an accounting firm. Think of the total value being made up of 2 pools. One is the tangible value. This would be what you would normally consider your accrual basis net book value on an accrual basis balance sheet. So it includes your receivables and your WIP and any, normally any accrued liabilities. Those aren't normally very high in an accounting firm, but they can be, I suppose. And that is one pool of value. It's sort of your liquidated value. If you were to, sell the firm or shut the firm down, what proceeds would be available to the owners. The other pool of value is the intangible value. And that oftentimes is tied to the revenue of the firm or the profitability of the firm. But, if you're into business valuations, you know that it encompasses more than just those issues. I mean, it encompasses the value of the client list and the employees and the name of the firm and all the things that make up the goodwill. So when we talk about a firm being worth 1 times revenue, or a firm being worth 0.75 times revenue, or a firm being worth, or a retirement plan being worth 3 times compensation, what we're referring to is the intangible value. Now, I've seen agreements where there's no value paid for the tangible value over and above the cash basis book value, but in most agreements we're dealing with that full value. So we may deal with the accrual basis book value, the tangible value, differently than we deal with the intangible value. One way that, for instance, that we might do this is go back to that, excuse me. Go back to the AAV method, and in the AAV method, we might charge a new partner only for acquiring their share of the intangible, of the tangible value, and not charge them anything for the intangible value, because they're going to earn that over time, through, again, participating in those different activities, as I mentioned before. So that's one kind of gives you an example of how the tangible value and the intangible value can be disconnected and dealt with differently. There's a common theory amongst accountants that firms are worth, a certain inherent value, and oftentimes 1 times revenue is used, or 3 times compensation. Tangible value in a CPA firm is based on the buyer's expectation of future results, just like it would be in any business valuation. And so what's important here is to keep in mind that the intangible value is not, you're not selling apples here. There's not a, CPA firms tend to be homogeneous, meaning that they all tend to be similar. That's why there's such a strong market for buying and selling firms. But what a particular firm is worth, and particularly internally, depends on a lot of factors that are other than just their volume. So I think that to go in and assume that a CPA firm has a certain value based on volume is a mistake. And what we're finding in the marketplace, getting back to these surveys, is that in fact there's a significant trend downward in the internal valuations of CPA firms. So in all categories of size, only 8% of, according to the Rosenberg survey, which is made up of close to 400 firms nationwide, only 8% of firms use a valuation in excess of 1 times. About 1 in 5 of the bigger firms and 1 in 4 of the smaller firms are using 100%, which I think surprises many people, because I think a lot of people assume that firms are worth at least 1 times. And you can see the rest of the categories down there. And in fact, 1 in 5 of the larger firms value their firm at less than 50%. Now, this would be applied to irregardless of the methodology that's being used. So, for instance, if we're using a multiple of compensation method, then let's say that we use 2.5 times is 30%. 2.5 times 30% is 0.75. And that would be converted to a 0.75 valuation relative to revenues for purposes of this survey. So this takes into account all the different methods. So why do external sales appear to sell at a higher multiple than internal buyouts? And I can echo that is in fact the case. We get involved in a lot of external transactions. So why is that the case? Well, first, external sales are the result of a bidding process. You're out, and one of your primary goals is to find the best deal. So, searching for the best fit, searching for the best firm. It's not unusual to talk to several firms, maybe even receive several offers, and therefore, be able to maximize under the circumstances what the best deal is. And one of those considerations might be price. Internal deals, on the other hand, are basically a put option. So if you've ever bought a put option in the stock market, you know that what that is you enter into a contract with someone, you own a stock, you enter into a contract with somebody that you can force them to buy your stock at a certain price at a certain time under certain circumstances. Well, that's in effect what your owner agreement is. As an owner of the CPA firm, you have a contractual obligation with the firm and maybe with your other partners to buy you out under certain circumstances at a certain price at a certain under certain conditions. And if you've ever bought a put option in the stock market, you know that there's a premium that you pay for having the right to do that. That, in essence, that premium is, in my mind, becomes a discount. Internal deals have an entirely different package of terms, and one of those is typically the retention adjustment. It's not unusual, in fact, it's common that an agreement would not have a requirement to change the price after the date of retirement as long as certain conditions are met. And as I mentioned before, we would recommend those certain conditions include executing a transition plan. But in almost every external deal, it's very, very uncommon that the deal would be fixed at closing. It's almost always contingent, and oftentimes contingent on as much as 5 or 6 years results after the sale. So that difference in risk that's assumed by the buyer, in the case of the buyer being the firm or the buyer being an external buyer, justifies a lower price. Keep in mind that internal deals are designed to keep the firm viable, and external deals are designed to maximize the liquidation value. I mean, that's why you do one of those two things. I mean, if you're going to have an internal transfer, what you're saying is, it's important to me that the benefits I get and the firm will get of staying independent are better than whatever I think I can get in the open market. If you felt like a better option was the open market, you'd sell the firm. So for these reasons and several others, I think it justifies that internal valuations are going to be lower than external valuations. So how do you determine whether or not you've got the right financial arrangement in your owner agreement? Well, we use the term backwards valuation, which means looking at the value of the firm and working backwards to the business plan, the terms, to make sure that those work for the firm and for the remaining partners. So what you want to do is reward the retiring partners for all their years of sweat equity and the value they've built up, but at the same time, you shouldn't be asking your remaining partners to borrow or take a step back in comp. I'm sure many of you have advised clients over the years on buying a business, and if you did the evaluation and you determined that the purchase was going to lose money for the next 5 years or next 10 years, you probably wouldn't go to them and say, gee, this is a really good deal, you're only going to lose money for the next 5 or 10 years. You probably would tell them, that doesn't look like a very good deal to me. Well, you shouldn't ask your partners that are buying you out to do the same thing. So how do you determine whether or not this is happening? Well, the available capital that you have for a retired is the retired partner's foregone comp. And you're going to use that capital for 3 things. First, you're going to pay off the retiring partner. Second, you're going to replace that partner, and there's a cost associated with that. And third, you need to leave some upside, some accretion in there for the remaining partners to make it to entice them to actually enter into this transaction. So how do we do that? Well, the first thing to remember is there's a basic premise that the owner that's leaving is being paid as an owner and should not expect to be paid for their equity at the same time that they're earning the same amount of money that they were as an owner. Let me give you an example. I run into a lot of situations where we have a senior partner who wants to start getting paid early because for whatever reason, maybe they're concerned they'll get paid, or maybe the firm wants to lessen the liability to them. So maybe we start buying them out in stages while they're still at the firm. Yet I oftentimes see that their compensation hasn't been adjusted for that, to recognize the fact that they own less, because the firm doesn't have a significant ownership feature in their partner compensation. Well, what's happening in that case is, in essence, is that we're asking all the partners to kick in, start paying for the buyout, and the only place that can come from is their own compensation that they would have otherwise earned, or borrowing money. That's a great example of a mismatch between the financial. It's a mismatch in cash flow. Let me walk through an example. In this case, we've got a partner earning $300,000. We determined that the replacement resources, in this case, are $120,000. Now, one way to do that, we're not going to certainly replace a $300,000 partner with a $300,000 partner. That won't work. Well, in this case, what we've decided is that what we need to at least do is replace their productive capacity. So maybe they generate, 1,200 billable hours at $250 an hour. That's $300,000. The cost, typically, the labor cost to generate that kind of volume is roughly 40%. So that's the $120,000. That's one way to look at this. I mean, we determine on a case-by-case basis what the replacement cost is going to be. But in this example, we've got $180,000 of capital that we have left after replacement cost, and that's where we have to decide how much of that are we going to use for the buyout and how much are we going to use for the to leave behind. So take this into a specific example. Say we've got a $1.9 million firm. This is an example of what doesn't work. A $1.9 million firm, let's say we're using the equity method. This particular partner owns 45%. They're making $275,000. Their capital account's $175,000. Our agreement requires that we pay the capital account off in the first year, by the end of the first year, and that we pay the retirement benefit, which is in this case $855,000. That's 1.9 million times 45%. Over 5 years at the rate of $171,000 a year. And in this case, let's assume the replacement resources were $125,000. So here's the analysis: the year one cash flow. We've got $275,000 to work with. Pay for the replacement cost, $125,000. That equals $150,000. We use $175,000 of the $150,000 to pay off the capital account, And on top of that, we pay $171,000 in retirement payments. The firm endures $146,000 of negative cash flow in that first year. There's only two places for that to come from. Either the other partners make $146,000 less, or we go to the bank and borrow it. And then in the next 5 years, we generate another $21,000 a year in negative cash flow. This is clearly not a self-funded plan, but it's not unusual to see owner agreements that are structured like this. So here's an alternative plan. Pay the capital over 5 years instead of all at once. Pay the retirement payments over 10 years. We're not changing any of the numbers. Otherwise, we're still going to pay the partner the same amount of money. We're just going to spread the payments over a longer period of time. So in years 1 through 5, we still have this $150,000 of available capital. We're only paying $35,000 against the capital account, and we're only paying $85,500 against retirement. So we've created $29,500 in the first 5 years of positive cash flow, and then years 6 through 10, it's $65,000 of positive cash flow. This is a plan that would be considered self-funding and therefore meet the backwards valuation test. Our final polling question, Nikki, is?
Final question is there on the screen. This one is, how many equity partners and shareholders do you have in your firm? So you can indicate your answer there. The options are 1, 2 to 4, 5 to 9, 10 to 19, or 20 plus. All right, that was a quick one. We've got everyone having responded. Looks like 60% of the folks on the call are in that 2 to 4 range, and then a mix between the other numbers.
Okay, very good. One of the really sensitive issues right now in owner agreements is mandatory retirement ages. Keep in mind, when we talk about mandatory retirement, we aren't necessarily talking about stop working. It's not unusual at all to allow a partner that's gone into retirement mode to continue working, usually on a per diem type basis. Maybe we pay them a percentage of their billable hours for billable work. If they ask them to do administrative work, maybe we pay them a different rate for that. But what we're talking about when we talk about retirement in an owner agreement typically is two things. When do they stop getting paid as an owner and go into this per diem comp rate? And when do they start getting paid for the buyout of their interest in the firm? The surveys, again, are telling us that of the larger firms, 88% of the largest firms, 78 to 88% have a mandatory retirement age in their agreement. As you see, the smaller the firm becomes, the less likely they are to have a mandatory retirement age. And when you get down to firms that are $3 million or less, it's very uncommon to have a mandatory retirement age. And I think part of that is because in many of those cases we've got 2 or 3 partners, and to force them out when we're not ready doesn't make sense. But keep in mind this, and again, I think most partners would say, I don't want to be told when I need to quit working. How do you know when I'm going to be incapable of doing my duties? I mean, why should you have the right to tell me that? That's just why I chose to operate in a small business like this, is to have those kind of choices. The problem is that there's consequences to that kind of decision, and that is that basically the firm is flying blind. So I've got this, go back to this firm that I'm working with right now with 10 partners. They don't have a mandatory retirement age. The fellow that has the very specific expertise in that firm is 66 years old. He has not given any indication of when he wants to leave. They've never forced it. Nobody knows. It could be 2 years, could be 5 years, could be 10 years. Regardless of whether or not he's capable of continuing to work that long, the firm is basically in a very vulnerable position because they don't know how to plan for when they need to replace him. I'm going to tell them, and I have told them, that you need to assume it's going to happen any time now, because it just makes sense that it's not likely that it's going to go much longer. Even if it only goes 5 years, it may take that long to get the proper replacement in place. But the firm is, in essence, flying blind with respect to all the partners. I happen to know, because one of them told me, that they're not going to work much beyond age 55 to 60. And they don't know that because they haven't had this conversation before. So, part of getting control of this transition of partners is having some control over creating a window either by using minimum ages for retirement and maximum ages for retirement through mandatory retirement. And that's in most firms that don't have, if you've got 50 partners and you're adding 5 partners a year and 5 are going out, that's not as big a deal. But when you only have 3 or 4 partners, one person leaving is a big deal, and replacing them is a big deal. The average age that we're seeing for mandatory retirement ages is about 66. There is a trend towards these increasing. I have run into firms as low as 55. That was a very special situation. Some of the biggest firms, and not very many of them, are using age 62. But most firms, the majority of firms are using age 65 still, and about 30% are between 66 and 70. Now, if you think, well, why don't we just make a mandatory retirement age of 75? You in effect you've just paid lip service to this issue, because that doesn't really create any kind of control. It just basically says we're really not going to force you to do anything. It's unlikely you'll work that long anyway. With respect to tax treatment and agreements, if you're in a corporation, usually you don't have any good options. You're going to have 2 ways to pay out a partner. One is for stock, which is non-deductible, and there will be a portion of the payout that is done that way. But the other one, of course, is deferred comp, which creates ordinary income and creates payroll taxes. If you're in a corp, you're in a corp. There's nothing we can do to fix that. All we can do is be realistic that that's probably how a majority of the payments are going to be made, is in the form of deferred comp. If you're in a partnership, though, you do have more flexibility. One of the things you can do is, under the code section 736B, is we can in effect buy your partnership interest and allocate a significant portion of the value to a goodwill asset, which can be amortized by the firm. And as long as we're paying you over a long enough period of time, say 10 to 15 years, then we can create little in the way of difference between the payments and the deductibility, and offer the seller, the retiring partner, a significant capital gain deduction. Most firms still use 736A, which means the payments are treated as retirement payments. If you're going to do that, then you need to become familiar with the rules of how to avoid self-employment taxes for the retired partner, and basically that requires that the payments be made over their lifetime. It doesn't mean equally over their lifetime. Normally we'd pay, most of it over 10 years and maybe $100 a month for the rest of their life, or sometimes we'll take the last year and spread that over the rest of their life. So it's not really a burden on the firm or retiring partner. The partner cannot continue doing any work for the firm. That's one of the big restrictions. If they do, then any payments that are made to them that year are treated as self-employment taxable, even if part of them are retirement payments. And their capital account, which refers really to the cash basis capital account, has to be paid by the end of the year that we're trying to get the exclusion from self-employment taxes. One other thing I'd point out is 409A. This is kind of an obscure code section, but it does have an impact. In order to be in compliance with the 409A rules, you have to, a retired partner cannot work more than 50% of the number of hours that they worked on average in the 3 years prior to retirement. If you fail that test, the potential is very dire. I won't get into what that is, but you should look it up. One of the things that we're doing in a lot of first-time agreements, and some of you have those, is using personal goodwill to create a strong tax outcome for the existing partners. So what we're doing in this case is assigning a lot of the existing value and the intangible value of the firm to a personal goodwill asset, which is then sold to the firm, and then we delay the payment. So it's if you can imagine an installment sale where the payments may not start for a long period of time, but we recognize that the firm has an obligation at the time we sign the agreement to that partner. And in order for this to work, you can't have any restrictive covenant that keeps a partner from taking business. So normally in a brand new agreement, there are no restrictions on partners, and we can take advantage of that opportunity. It also we've used it in a few cases with our mergers and acquisitions. If all else fails, 2 things to consider. A call-out sale is selling off a portion of this is where you look at it and go, you know what, we can't do this. We don't have the people to replace the partners. We don't have a partner we can replace or want to replace. So in this case, you know, a call-out sale would be selling off a portion of the clients, downsizing the firm, or potentially selling off an office. An example of that, a deal I worked on several years ago, was a fellow that was in it's a Midwestern state. The firm was located in the largest city in the state, but they had a satellite office that was hundreds of miles away that was in a very small community. No one in the large office wanted to go down to that community to replace the retiring partner, so we sold that office off with the partner to another buyer. Another example would be you know, selling off a partner. You know, you don't have to necessarily be in an office, separate office. It could just be, we can't do this. Let's find a home for you and your book of business, and let someone else basically take on that responsibility. And then, of course, you know, Plan B is always an upstream merger. I would tell you that give yourself at least 2 to 3 years to find a suitable merger partner before you have to find a replacement for retiring partners. That way you find the best deal, you find the best match, you know, and hopefully that'll work for you. I would refer you to 3 series of articles that are on our website. In the copy of the PowerPoint, you can download all of these from our website. I'd also refer you for more information to the AICPA's Succession Planning Resource Center. We had a hand in building this, and it has a whole lot of information, including you know, guides and tools, a succession timing calculator, and so forth. And then a shameless plug for a group that I'm a part of, which is the CPA Consultants Alliance. You can see the other members of the Alliance on here, all very well-known consultants in the profession. We just released a book in April that was written by all of us, called Bridging the Gap. You can get that book at Amazon for around $50. And we also have, you can download from our website 3 white papers that we've written over the last 3 years on these different issues, which all are related primarily to, you know, at least indirectly to succession issues. Thank you for attending today. Nikki, I'll turn it back to you.
Okay, thanks so much, Terry. After the webinar ends momentarily, the survey will pop up immediately, and you'll complete that right there. So please take a moment to do that before you close the browser. You'll receive an email that will come in about an hour or so, and that'll include links to all the articles that Terry mentioned within the presentation. And then within the next 10 business days, you'll receive an email with your CPE certificate once you've met the requirements. And then also, if you indicated that you'd like the generic transition plan, you'll get that not today, but when you get your CPE certificate. We thank you all so much for attending. If you have any questions that might arise, feel free to reach out directly to Terry, or you can reply to those emails. They come to me, and I'd be happy to pass them on for you. All right, thanks so much.
Bye.